As we turn the page into the new decade, into the new year, there's a tremendous sense of optimism on the heels of strong stock market gains and obviously the longest U.S. economic expansion in modern history. With that said, I think we always look forward to a chance for reflection in the new year, and reflection starts with your portfolio. There's two dynamics we look forward to every January. One is the so-called January effect, the end of that tax loss selling in December, much more muted than normal. We expect a more muted January bounce because of it. The other dynamic, of course, is window dressing. Window dressing was more pronounced last year. We saw Apple and Microsoft leading the market, 15% of the S&P returns. That is pushing people into technology names, losing their heads. Portfolio reflection means looking more broadly, looking outside. Today, PBOC, that injection of liquidity, emerging themes should be emerging markets. I agree with that. It means international. It means looking more broadly outside of last year's leadership, and it means rotation into 2020. That's what I'm much more excited about. Diversification doesn't mean owning Apple or Microsoft. It means owning other companies. It means owning other countries, other industries. The rotation that we saw in energy names coming in, I think, is a sign of things to come. It's about growth, not just about multiple expansion. Last year, tech was all about multiple expansion. We need to look more broadly, wait for the earnings to come out to see if fundamentals can catch up with the stock market performance that we saw last year. Look, there's no doubt by the end of last year, it was getting priced into the market. And David made a really good point early on, which was there was $2 to $3 trillion worth of cash that was getting pushed off the sidelines as money market yields were coming down. As that money really started to accelerate towards the end of last year, and by the way, it may continue into this year, that money's got higher expectations. So if the earnings aren't there, stocks ultimately will track those earnings. But I think when you really dig into the weeds, you're going to see certain areas of the market that may have been fundamentally pushed up in valuation. Low volatility, for example, was one area that became a great theme. It made a lot of sense. It was very defensive. But you can't hide your way into prosperity. You've got to have the earnings growth. You can't just have the multiple expansion. And by the way, I think going into an election year, we'd have to be insane to take this market or this economy for granted. At the end of the day, it's all about the fundamentals. And all the liquidity is really great, and the liquidity really helps, and liquidity has driven us so far. And we should send a gift basket to Fed Chairman Jay Powell for last year, but we need the fundamentals to maintain really strong and pro-growth policies to enable that.